That was an excellent presentation, and certainly a good reminder that other things are available, not just investing in individual stocks. For those who need to be reminded, you can put your questions in the chat box, and I will read them and Michael will answer them. If you haven't opened the chat box yet, you can click on the chat box bubble, or if you don't see a bubble, try using the Alt and H key at the same time, and the chat box should appear. We have some questions, but before we get to the questions, I just want to remind you that Michael's slides are going to be on our website, and you'll get an email with the website address after the presentation. Also, as I mentioned earlier, we have other seminars coming up, and they're announced in the newsletters, so make sure that you read your newsletters. Now let's get to some of the questions. First question is, what criteria do you use to pick a company or stock to buy? And I want to remind people again that Michael does not provide advice. He provides information. So Michael, I'll turn the question over to you. But just a caution to people that it is not advice on which stock to buy or to pick.
Yeah. Can you repeat that question, Alain?
The question is, what criteria do you use to pick a company or stock to buy?
Well, the first answer to that is that I believe that 99% of retail investors should not be picking individual stocks. Frankly, we just don't have enough information. We're not good enough at it. Plus, we're competing with some amazingly talented people out there, many of whom are being paid millions of dollars a year to do exactly that. And so I liken picking individual stocks to deciding to have a pickup hockey game with the Ottawa Senators. And the fact is that even though the Senators may be one of the worst teams in the league, they're all still pros, and they're still going to whump us because we're not pros. So, you know, I find it interesting that people continually want to pick individual stocks. I mean, you wouldn't go down and probably try to repair your car engine today. You'd turn it over to an expert. You probably wouldn't go and try to do your own legal advice. You go to an expert. And so I don't know why we've been convinced that we non-experts should be picking our own stocks. So anyway, a long way of saying, I think people should, for the most part, buy funds. And I think for the most part, they should buy exchange traded funds, which tend to be low cost. And so as, for example, as the one that I mentioned, XGD, which is the Global Gold Miners Fund, it has a management expense ratio of, I believe, around 0.65. And for that, you get 37 of the top gold mining companies in the world with one click of a mouse if you've got a direct investing account. So my response is, don't try to pick individual stocks.
All right, thank you, Michael. We have another question here. Where do you go to get physical gold?
Well, there's a number of ways of getting physical gold. You can go online to gold brokers, and you'll find some online, including here in Canada. You can go to your bank, and they will sell you things like gold coins, and you can even buy mini bars through the bank, but they tend to charge a very high markup. You can even buy, you know, full regular bars of gold, but a full regular bar of gold today, I think, is worth about $250,000. So it's a bit of a, you know, tough thing to use as a doorstop. Rather than do that, I prefer to buy the gold bullion ETFs, which for a very low price hold the physical gold on your behalf. And so if you have US dollars, the big daddy of gold bullion ETFs is called GLD. It has a management expense ratio of around 0.5, 0.5%. You can buy it and sell it instantly on a online brokerage account. You can even buy one in Canada, an ETF called MNT, as in Mary Norman Tango. And that's actually run by the Royal Canadian Mint, believe it or not. And it actually holds physical gold on your behalf. And once you get to a certain amount of it, it's around $10,000 worth, you can actually arrange to drive down to Sussex Street, should you want, and pick up your gold. So those are some ways of holding physical gold.
All right. What about silver? Does it behave similar to gold?
The answer is sort of. The issue with silver is that it's much more of an industrial metal than gold is. I mean, gold primarily is used in jewelry and for speculation. Silver, most of it is actually consumed in industrial processes. And as a result, it has some of the similarities of gold, but because so much of it is controlled and used by the industries who use hedging and other forms of investment, it often does not work quite the same as gold. If you want something that hedges against the stock market falling or that reacts best to interest rates, gold seems to work better than silver.
All right. What about the performance of other precious metals, such as platinum?
I haven't really looked into it. Again, they don't seem to have quite the same take up as gold does. The thing is that around the world, for whatever reason, for centuries, people have liked to wear gold and to have gold. If you go to China or India, for example, there's stores all over the place lining the main streets selling gold jewelry. Same in the Middle East. And I've just never seen this for any other metal except gold. So I'm not entirely sure why. Maybe it's something that we've gotten used to, but gold seems to be the preferred precious metal.
Yeah, when I was in Florence, I certainly saw that in spade. There's a whole area around the Ponte Vecchio that's lined up with boutiques selling gold. The next question is, when would be a time for someone to sell out of gold?
Well, that's a good question. To answer that, I would say go back and look at the historical charts. And if you look at the period from 2000 to 2012, history shows us that it was a good time to sell out of gold once the S&P 500 got back to its 2000 level. Now, having said that, there was a head fake in about 2007. So it's awfully difficult to know when you should sell out of gold. But I would guess that given that gold tends to react negatively to the stock market, so when the stock market is doing really well, typically you might say, or let me rephrase that, when the stock market has done really well and the future is maybe not that rosy because it has done so well for so long, that might be a good time to be owning gold. Conversely, once the stock market has bottomed and things are looking pretty desperate, by that time gold's probably gone up a lot in price. That might be the time to lighten your load. But overall, what I would say is use the balancing approach. So if you decide that you want to have, say, 5% gold in your portfolio, if gold does really well, you might find that that 5% goes to 10%, at which time you might want to rebalance all of your portfolio back to your standard amount. And that will give you some idea of when to sell your gold.
Okay. In one of your conclusion, you mentioned owning 5 to 10% of gold as insurance. How much insurance does that really reflect for the remaining 90 to 95% of the portfolio?
Well, it's a good question. It depends what your portfolio is in. Let's say that your portfolio is in a classic 60-40, 60% equities, 40% bonds. If you've got, what tends to happen is when stocks go down, bonds go up. And by the way, in 2 weeks, we're going to do a webinar on bonds and preferred shares and talk about this. But so your bonds are going to offset some of the loss in stocks if stocks go down. And then let's say that you've got 10% of your portfolio in gold miners. That 10% could easily grow to 20% over a period of time. And so between the bonds and the gold miners, you might protect up to half of your equity investment. So it's hard to say exactly how much it will protect. Every situation is different, but it will give you at least some protection so that if the stock market tanks by 45%, like it did in 2008-9, your loss is going to be a lot less than 45% of your total portfolio.
All right. What that underlines to me is that don't put all your eggs in one basket. Diversify your portfolio.
Exactly, Alain. Diversification, particularly today, is absolutely the strategy to take. And using gold as part of that diversification strategy would seem to make sense, particularly based on history. And as I remind people, remember the words of George Santayana. And also, if you look at the recommendation from these very astute strategists.
Yes. What's the impact of gold mining as a sustainable investment?
Well, gold mining, like any mining, is a big and pretty tough business. I mean, right now, gold yields are in the order of like 2 grams of gold per ton of ore extracted. That's a good mine. So I can't even do the math on that in terms of how many tons of ore has to be moved and milled to produce a kilo of gold, but it's a lot.
Yeah.
And a new gold mine, a big new gold mine costs, in the billions to develop. So these are not environmentally light projects. Having said that, virtually no mining today is. So if you are very concerned about the environment, mining, energy development, any of these things is perhaps not something you want to be involved in.
Yeah, I can certainly vouch for that because I was born and grew up in a region where there's a lot of mining, including gold mining, and it is not environmentally friendly. As a matter of fact, there was a gold mine just across a golf course where I played as a kid, and there was a lake separating the course and the mine. Some days we could almost walk to our ball if we hit it in the water.
Right. Yes. Well, luckily, environmental standards have improved, but look, it's like trying to convince people that the oil sands has low environmental impact.
Yeah.
Anyone who's been up there and seen it knows that's just not so.
Yeah, I'm talking more than 50 years ago, but I didn't hit too many golf balls in the water. Anyway, should gold investment be a mix of hard bullion, mining stocks, royalty streamings, other forms?
Yes, and in fact, in my personal case, I've got about 1/3 of each. So 1/3 of a gold bullion ETF, 1/3 in a royalty streaming company, and 1/3 in the global gold miners ETF. And the reason for that is diversification, which you raised, Evan. But it also goes back to the first question about how do you pick a stock? You know, I'm not capable of, frankly, picking a good gold mining company. I just don't know enough about it. And I really don't want to spend the time trying to figure it out. And even if I did, you know, frankly, unless you spend a lot of time running around gold mines. And by the way, I have to point out when I was deputy minister in Manitoba, I was responsible for the energy and mines department. And I used to run around gold mines. So I've actually been and seen these things. And I still would not try to figure out which company was a good one to invest in. So I own the ETF, which has 37 different companies in it. Franco is a bit of a different kettle of fish because to me, Franco is essentially a managed ETF. You've got a bunch of very smart people who've been doing this for a very long time, who've made a lot of money doing it, and they are essentially picking the companies for you. But even then, as I pointed out, they've got 57 different companies actively providing them revenue. So it's diversified. The reason I don't own just Franco is because it's expensive. The price to earnings ratio is very high, which reflects how people value it as a company. And then finally, just having gold itself, it's a little bit safer than owning the miners. Stuff can happen. For example, recently there was a coup in Mali where there's 3 or 4 gold mining companies operating. And the day after the coup occurred, their stock prices tanked by 20%. Now they've recovered. The fact is, it doesn't matter, I guess, who's running Mali. They still want the money from the gold mines. But I just felt that having this balance gives me a bit more diversification and therefore a bit more safety.
Next question is, where can we find more information on one ETF called CGL.C?
Just Google it. The parent ETF is CGL. It is a iShares ETF. CGL is basically Canadian gold, and it's Canadian gold bullion. And CGL.C is exactly the same thing, except it is unhedged. So CGL is hedged to the US dollar. CGL.C is unhedged. Just Google it, look it up online, and there's lots of information about it.
Yes, and another question related to physical gold. Where do you sell it?
Well, I think you sell it same place you buy it. So most banks, I think, will cash it in for you. And there's all these people who keep advertising on TV promising to do it. It reminds me, if I may digress, Alain, I've told this story before, but you know, some people really like physical gold. They feel that it offers safety. And a number of years ago, when I was in Hong Kong, I received a call one day from an extremely wealthy, multi-billionaire Hong Konger that I knew. And he said, Michael, I wonder if you can help me. I have a little problem. He said, back a number of years ago, before handover of Hong Kong to China, I put a couple of gold bars in a safety deposit box in one of the banks in Toronto, one of the big banks. And this was by this time about 2000. He said, feeling more confident now about the handover, and the price of gold's gone down, so I'd like to cash in those bars. But I'm a little worried that if I show up at the teller with $1 million worth of gold in a cart and try to cash it in, that it may raise a few questions. So how could you help me? So what I did is I knew the local Hong Kong manager of that particular bank, who I knew would be delighted to get to know a Hong Kong multi-billionaire. arranged for the two to get together, and he arranged for the delivery of these gold bars in the Toronto bank, for which the gentleman received his cash. So that's how you do it.
Yeah, that's not a bad problem to have. Any cryptocurrency edge to gold?
You know, I don't understand cryptocurrencies. I've never understood cryptocurrencies, and I don't think I ever will understand cryptocurrencies. So, and maybe Ella, you understand them and can explain why people want to own them, but I can't understand why anyone wants to own something which is basically created out of almost thin air, controlled by nobody, and has no value to a consumer. I just don't get it. Do you?
Well, I've read a number of articles in professional magazines about cryptocurrency and in other places as well. I don't profess to understand it, certainly to any large degree, but my only thinking about cryptocurrency is that it has nothing physical behind it. Like you said, it's created out of thin air, and any asset that doesn't have anything physical behind it, to me, is a very large risk. So it's not something that I would get into personally, and it's certainly not something that I understand enough to be able to tell people whether it's a good value or not. I know people that have made a lot of money in cryptocurrency. I know people that have lost a lot of money as well. So,
yeah, I mean, there were cryptocurrencies created which were basically just complete figments of somebody's imagination.
yeah,
They took
yeah,
in tens of millions of dollars and it basically disappeared.
yeah.
There are cryptocurrency exchanges who somehow seem to have lost billions of dollars worth. I mean, I don't get it. So,
The next question is, did XGD not drop 40% in March? So that's one particular ETF.
yeah. Well, XGD is the Global Gold Miners ETF. And yes, it did drop a lot in March, as did gold. But what happened in March is that everything dropped.
Yeah,
And I think what some people think happened is that there were a lot of people, particularly big investors in the US, who had invested quite a bit on margin. In other words, with borrowed money, particularly in some of the hot stocks. And when those stocks went down fast, there were what were called margin calls. In other words, you have to come up with cash to keep your margin at a certain amount. And people just had to sell off anything they could to come up with the cash. Because if you look at what happened in that March period, the sell-off on everything seemed to be completely without any reason whatsoever, including bonds in some cases. So when you get this panic situation, everything goes flying out the window. But if you look at what happened shortly thereafter, in the rebound of the market, the gold miners, XGD and gold itself, rebounded extremely quickly.
is gold already at a peak price and therefore a bad time to buy gold now?
Well, of course, if we knew that, then we would all be actually in Bora Bora, sitting on my yacht. You can see my yacht in the picture here. I don't know. All I can tell you is this: prior to 2000, the record price of gold was just over $1,900. That was back in 2012. Gold hit a record price a month or two ago at about $2,050. Today, it's under 1,900. So I guess you have to ask yourself, is this a reasonable price for gold relative to history? And ask yourself, what do you think about the future of the economy and therefore the stock markets? And that's why we ask those polling questions at the beginning, where the majority of you are not too excited about the future of the Canadian economy. And there's a pretty simple relationship between the Canadian economy, GDP, corporate profits, and the stock market. So I don't want to be predicting anything, but again, go back to my basic thesis. This isn't about trying to figure out what the price of gold might do. It's about buying portfolio insurance. So.
And also the danger of trying to time the market.
Yeah,
nobody can successfully time the market, or very few people anyway.
Yeah, but I will mention that David Rosenberg, in his Breakfast with Dave newsletter this morning, did say, and this is his opinion, not mine, did say that gold at this price is a buying opportunity. But that's David Rosenberg, not me.
Yeah. Our next question is, if no new mines are opening, where's the growth potential? And the question, the person asking the question is trying to understand the upside of buying gold right now.
Well, first of all, there are some new mines. There are no new major mines, number one. And second of all, a fair amount of gold is byproduct of other mining. So copper mines tend to produce some gold, for example. But if there is no new major gold mines, that's actually positive for the price of gold, because there's still demand in the world for gold. As I showed you, central banks are buying it. And as economies return in India and China, those parts of the world love consumer gold. So the demand for gold may stay or even rise. And if gold production decreases, well, it seems to me that should push the price of gold up, should it not? Yes. So it's one of those cases where less is more.
Next question is, does FV pay a dividend or distribution?
FNV?
The asker of the question just said FV, but it could be FNV.
Yeah, I think they're talking about FNV. The answer is a small dividend. I think it's less than 1%. Franchement, you don't buy these things for dividends.
Yeah, they're more an insurance, as you said, or possibly capital growth.
Yeah, you know, gold itself, gold bullion pays nothing in the way of dividends.
Yeah, no.
The mining companies pay very low dividends. No, this is not something you buy for dividends.
Yeah. There's a question that I think you've answered, or at least given some indication in a previous seminar. Could you please provide a percent breakdown of a portfolio by asset classes?
Well, it depends. It depends on the individual and depends on your stage in life. Depends on whether you're collecting, having to take income out of a RIF. You really can't answer that question. Having said that, the classic historical portfolio breakdown has been the 60-40. 60% stocks of the world, 40% bonds of the world. And into which I would say that today you might want to take part of that and maybe go, 55% stocks, 5% gold, 40% bonds. But there's no magic number. Given what's happening with low interest rates and what's happening with COVID and the economy, I really have no clue. But I would certainly err on the side of safety, and that means diversification.
And what seems to be our last question, oh, no, sorry, there's another one that came in. The next question is, can you buy gold bullions from the Royal Canadian Mint listed on TSX?
Yes, it's, again, they have, the Royal Canadian Mint has it's actually called an exchange traded receipt, and the symbol is MNT. So Mike Norman Tango, and that is the equivalent of buying gold bullion through the Royal Canadian Mint. And as I mentioned, if you buy enough of it at some point, not really exactly where it is, something around $10,000, you can actually arrange to go to the mint and pick up your gold at some point.
Or you can go and visit it at the mint.
Yeah. Yeah, you can, when they have tours again, you can go in and say, where's my gold?
Yes. Next question is, I thought that I read recently that the Bank of Canada has sold its gold.
I don't know if the Bank of Canada sold its gold or not. I'm not sure. But all I do know is that that slide that I showed you, which is produced by the World Gold Council, shows that overall the central banks of the world have been adding to their gold holdings.
Yeah, yeah. Okay, so that's the end of our question. I want to remind people that we will be posting the slides of Michael's presentation on our website, and you will get an email giving you the information on where the slides are, how to access the slides. And as well, if you're interested in Michael's seminars that are scheduled for October, you'll get the information on registering in our newsletter. So Michael, on behalf of the Ottawa branch of the National Association of Federal Retirees, I want to thank you for your excellent presentation. And I want to thank everyone involved as well in making the presentation possible, especially our guru, Frank Schidler, who's the one that takes care of all of the technical details of making sure that this works. Frank is a member of our association. He retired from CRA in 2016. And at CRA, he was instrumental in looking after the taxation databases. That's a pretty important job, but what he's doing for us is equally important. Don't forget to watch your emails to get the information on where to get copies of Michael's presentation. And also don't forget our mega recruitment drive and the grand prize of $10,000 cash. I think that would buy a little bit of gold, as a matter of fact, once you get your hand on the cash. So thank you very much, everyone, and stay safe and take care.
Okay. Thank you very much, Alain. And I'll just note that October 7th is the webinar on bonds and preferred shares, which I think people will find very interesting, particularly as a way of diversifying. And then October 21st, we're going to talk about one decision investment portfolios using the relatively new asset allocation ETFs. And then finally, November 25th, how to select a financial advisor, an advisor with an E, not an O.
Yeah, and you'll tell us what the distinction is, Dan, for those who don't know.
Thank you very much.
Thank you. Thank you, everyone.
Bye.
Bye-bye. Ciao, ciao.